problem 3 on page 336. But before we get back to that, I just want to step back and talk about the benefit of 743B. And so if we compare partnerships to S corporations, there's no corollary to a 754 election for S corps. So if you're an S corp buyer, you buy shares of an S corp from another shareholder, you'll get a high basis in your S corp shares, but the inside basis of the S corp assets will remain the same. And you'll get allocated your pro rata share of any gain. There's no 704C in S corps, as we know, and there's no step up under 743B. And so this is yet another advantage of partnerships over S corps, that the buyer can get a stepped up basis through 743B. And again, that stepped up basis in a highly successful business is going to be in goodwill, which means that that buyer of a partnership interest is going to get amortization deductions of that goodwill. Whereas the same business in an S corp, the buyer of the stock is not going to get those amortization deductions. And so just keep that in mind. Yeah, there's just a few differences between S corps and partnerships, and I try to point those out. Another one we've talked about is 752, that in an S corp you don't get outside basis credit for inside debt in the same way you do with a partnership. So, but turning back now to the problem, let me pull this up. We're dealing with this problem here. It is DEF partnership. And with this DEF partnership, we have a built-in loss with the partnership. So it's a $200,000 built-in loss. It doesn't reach the 250,000 threshold where we'd have a mandatory 743B adjustment. So if you have a built-in loss of more than 250, that's a substantial built-in loss. And then you're going to have these special basis adjustments that are net downward, whether you like it or not, whether you make a 754 election or not. So because we're below the threshold, now we can choose, and we talked about how in general, you wouldn't want to make a 754 election when you have a net built-in loss, because your SBAs, your special basis adjustments, are going to be downward instead of upward, at least on a net basis. They'll be downward, and you want more basis rather than less basis. So the answer in A, where D is purchasing G's interest, or G is purchasing D's interest, is that nobody wants a 754 election here. And then we can kind of play this out in B to say, okay, what would happen with no 754 election if, let's say, the inventory and the land were sold? What would happen to G? The land is easy. The land has a basis of 270. It's sold for 90. There's a 180 loss. That's not 704C property. That was property that was purchased by the partnership. So 60,000 of the loss would go to G. So that's a phantom loss to G. I mean, G bought into that land at its fair market value. And so that 60 of phantom loss is going to be offset eventually by phantom gain for G when G sells her interest or liquidates her interest. But the time value of money is going to mean that she likes this phantom loss that she gets now. Okay, so that's pretty straightforward. The inventory is a little trickier because the inventory was contributed by D, and it had a value, it had a fair market value at the time of contribution of 15. But its basis was 30. So again, drawing it back in time, D purchased the inventory individually for 30. It dropped in value to 15 on D's watch. Then D contributed to the partnership, and then it dropped another 5,000 in value while it's held by the partnership. So this is 704C property. And here, I'll put this up on the board to see under 704C what would typically happen So we've got G, E, and F. We'll just put their book tax capital accounts up. And we've got this inventory here that has a book value of 15. That was a fair market value contribution and a basis of 30. And what would happen if it's sold for 10? So it's a good review of 704C. Now we're selling 704C property. If we sold it for 10, we'd have 5 of book loss and 20 of tax loss. And under the normal 704C rules, we would allocate the book loss next. So that would be 1.7 to each. The next step would be to allocate tax loss to the non-contributing partners, which is here is E and F. G is a contributing partner here because G stepped in the shoes of D with regard to capital accounts. So G steps into D's 704C responsibilities. And so we would give each of E and F 1.7 of tax loss. And then whatever's left, which is going to be 16.7, would go to G. And what's that 16.7? It represents the 15 of built-in loss plus G, this share post-contribution loss. And that would be the normal rules under 704C, what we've learned. That would be the answer. And if that were the case, again, it's another great result for G not making a 754 election, because he gets to report 16.7 of ordinary loss right now. And a 754 election would create a 743B adjustment that would wipe this out. So we'd rather have this loss now. Any questions about that? All right, now one caveat. Congress was worried about these, the ability of people like D to sort of duplicate their loss, their built-in loss. Remember, D is going to get that loss too when D sells. And so Congress drafted 704C1 Cap C, which we didn't cover in detail, and I won't test you on. But it's worried about sort of shifting of built-in losses. And what it does in this context is it's going to say, G, because you were not the original contributor, you're not going to be able to get D's 15 of built-in loss. So we're going to take G's loss and come in and make it only 1.7. The 1.7 is G's loss because that's G's share of the 5 of loss after contribution. But the pre-contribution loss is going to be exclusive to D. And it's a one-way street. This would result only applies to losses. If these were gains, if we reversed it, G's going to get socked with those gains unless there's a 754 election in effect. And even now, again, it's still good not to make the 754 election because G will get this early 1.7 loss, which is ordinary. G also is going to get that 60 of loss on the sale of the land. Capital loss, not as good as ordinary, but still now. And then later on, when G liquidates her interest, she's going to end up with 61.7 of phantom long-term capital gain. And again, that's a good trade-off. 1.7 of ordinary loss early, 60 of early capital loss, followed by later on down the road, 61.7 of long-term capital gain. That's a good deal. Even better if G dies, because then that phantom gain is going to be wiped out through the stepped-up basis. So the bottom line for this problem is going to be you should understand that just like 743B adjustments are good when we have an appreciated partnership, they're bad when we have a depreciated partnership. And so that's one of the costs of making 754 election is, well, now you make it because it's an appreciated partnership. Maybe down the road it's depreciated and you're stuck with it. But if it's a first time question, then you might as well pass on making 754 election here. And then also recognize that this opportunity to sort of play heads you win, tails you don't lose against the government is limited, because once you get a substantial built-in loss, then you're going to have to make the 743B adjustments downward. So this problem has the electivity because we're shy of a 250 built-in loss. Okay, any questions on that? All right, so now we're going to move on to the next topic, which is going to be distributions. So let's emphasize something at the outset. We have to distinguish, again, in our minds, keep these very clear, the difference between allocations and distributions. They're easy to get confused. We have to keep them straight. We allocate tax items, items of income, gain, loss, deduction, and credit. We haven't covered credits in this class. We won't talk about them, but tax credits are also allocated. You distribute cash or property. And the taxable event in the context of partnerships is the allocations. When the partnership realizes income, that income is allocated to the partners and then is taxed to those partners. Distributions, at least in theory, are not taxed because we're taxing the earning of income. We don't tax, again, the distribution of income. It's kind of like if you individually earn $1, you're taxed on that dollar. You're not taxed again on that dollar when you spend it or move it from one bank account to another. So the same thing with partnership. With a partnership, the partnership earns $1, it's allocated to you. You've been taxed on that dollar. When we distribute that dollar, there should be no tax. And we do that in part, we accomplish that result, as we've seen, by adjusting outside basis. When you get allocated $1 of income as a partner, your outside basis goes up by $1. That extra $1 of basis in your outside basis will then shelter $1 cash distribution. So that's the way it's supposed to work. We're going to see it doesn't always work out that neatly. But allocations are where tax and distributions are not really supposed to be taxed. We end up taxing distributions really because administratively it becomes difficult to get the conceptually correct answer. So things like negative basis become a problem, or keeping track of your ordinary income versus capital gain. We just can't keep track of it reasonably, and so we end up taxing you sometimes, as we'll see. But the general rule is that distributions are not taxed. And that's consistent with single level taxation. Those of you in my corporate tax class, you know that when corporations earn income, corporations are taxed. Then when the corporation distributes that income in the form of a dividend, that distribution is taxed again. That's double taxation. With partnerships, there's supposed to be one level of tax. Okay, so let's keep that straight. Distributions versus allocations. And we're going to be dealing with distributions. We've covered allocations before. Allocations was all that ugliness in 704B and non-recourse deductions and 704C allocations. Those were all dealing with allocations. Now we're dealing with distributions of cash or property. Any questions on that? Okay, another thing to keep in mind is that there's a distinction in the tax law, partnership tax law, between liquidating distributions and non-liquidating distributions. And it's a pretty simple standard. It's a non-liquidating distribution, which is what we're covering now, non-liquidating, or they can call them operating distributions or current distributions. We distinguish those from liquidating. It's liquidating if after the distribution you're out. You're no longer a partner at all. So it gets, it seems kind of weird because you could be like a 50% partner and then receive a distribution that as a result of the distribution takes you down to being a 1% partner. And economically, you've liquidated what, 98% of your interest, but it's still treated as a non-liquidating distribution for these rules because you're still a partner. Okay. So with that general background, let's take a look at the code. We're going to be mostly in the code for these. So let's turn to section 731 of the code. We've seen this before. Section 731. It's a pretty simple rule. 731A1, in the case of a distribution by a partnership to a partner, and it says gain shall not be recognized to such partner. So there's your general rule of distributions are not taxed. But we have the exception, except to the extent that any money distributed exceeds the outside basis in the partnership immediately before the distribution. So we've seen this before, we've seen it play out, and again, here we can say we tax distributions when we receive money in excess of our outside basis. And we do that because if we didn't tax you on that excess, we would then have to give you a negative outside basis because we have to reduce your outside basis by the money received. Otherwise, you'll end up having gain escape the system. So again, we sort of have three choices when we have a distribution in excess of outside basis. Door number one is we can tax the excess, and that's what we do. Door number two is we could have it be tax-free, but give you a negative basis. Then we got to deal with negative basis. And we choose not to do that. The tax law has chosen not to do that. The third is probably presumably the worst, which is we could just say, okay, you get to get a tax windfall. We won't reduce your basis negative. We won't tax you now. And that means that we're going to just allow you to have tax-free income. And so we choose not to do that. So we choose to tax you on that excess. So that's, we've covered that before. At 731A2 says loss shall not be recognized. So again, we have the general rule that distributions have no tax consequences. And here we have the exception. But if we have a distribution and liquidation of a partner's interest, so if we have a liquidating distribution where no property other than certain property, certain hot assets are distributed to such partner, loss shall be recognized. And so we've seen this before. If you receive only money, you receive a liquidating distribution that's only money, only cash, then you get a loss if the cash is less than your outside basis. It's a liquidating distribution. We're going to talk about liquidating distributions later on, so I won't belabor this point. Any gain or loss should be treated as gain or loss from sale or change of partnership interest. This ends up being just capital gain. This will end up being a capital gain or loss if it's lost, but capital gains are focusing on non-liquidating distributions. long-term if you held the partnership interest for more than a year prior to the distribution, short-term if you didn't. No gain or loss recognized to a partnership, so you don't have any partnership recognizing any gain or loss. Here again, there's an important distinction between S corps. So if you're an S corp and you distribute appreciated property in the S corp world, the rule is the S corp would recognize that gain on a distribution of appreciated property to a shareholder, and so that gain will be recognized and then allocated to the partners. And so one of the beauties of partnership, again, over S corps is going to be if you hold appreciated property, you can distribute that property to the partners and have it be tax-free, no immediate tax event. Whereas if it's an S corp and you're distributing the property to the shareholders, now that is an immediately taxable event. There's only one level of tax in an S corp, but it's immediate tax as opposed to with partnership you get tax-free. So we're kind of seeing why, for example, if you have a capital-intensive business like a real estate business, partnerships end up being preferred over S corps. Again, we see here that if you want to distribute the property, move it around, it's easy in a partnership, not so much in an S corp. If you have debt that's financing the property, then you get outside basis credit in the partnership world for that debt, but not the S corp world. If you have a buyer of a partnership interest, they can get 743B adjustments. If that's 754 election, in fact, an S corp buyer can't get that. I say capital intensive because if it's like a service business, then those issues really aren't as significant. So those are the main rules. There's marketable securities. Securities are traded on an active market like the NASDAQ or New York Stock Exchange. Those are treated as money for certain purposes. We're not going to get into those details. And then we have a related rule related to 731A1, which is our friend 752B. So let's turn to 752. We have our constructive or deemed distributions of money when the partners share partnership liabilities goes down, or a partner's individual liabilities goes down because a partnership assumes the debt, treated as a distribution of money, a deemed distribution of money that then kicks you into a 731A1 analysis because of that deemed distribution of money exceeds your outside basis, you have gain. Okay. Any questions about 731 so far? One issue that comes up is going to be, okay, what's the timing of the distribution? When do we, and again, if you think about it, you have a distribution of cash. When do we decide, when do we compare it to the outside basis? Because really that's the key, right? The distribution of cash, the question you need to know is your outside basis high enough to absorb that distribution of cash? And the general rule is that the distribution is going to be tested to see what the outside basis is on the date of the distribution. So on the date of the distribution of money, you'll need to know what the outside basis is on that date. Now there's an exception to that rule for what are known as draws. A distribution that's a draw is one that is really a loan. It's a draw against your future distributive share allocation of income. And this is very common in service businesses. And the easiest way to understand this is probably through an example. Let's say you become a partner of a law firm on January 1. And typically, when you become a partner in a law firm, you're not going to make a significant capital contribution. generally because law firms are not capital intensive. You might have to make some small, relatively small amount, but generally not a big amount of capital contribution. Let's just assume it's zero. And now that you're a partner, you receive partnership distribution, but because you contributed no money, and again, let's assume the partnership has no debt. And law firms will have some debt, generally not significant. So your outside basis is zero. And with a law firm, again, they'll do, let's say, monthly draws. So you went from being an associate the prior year. Let's say you were paid twice a month. So you got a paycheck, you got a W-2 wages on the 15th and the last day of every month. And then you become a partner and you no longer get a W-2 wages. Now you get a distribution at the end of the month. And the distribution is generally going to be based on what your expected ultimate allocation is going to be at the end of the year. And law firms have different ways to, compensate partners. Some are like a really what they eat what you kill basis. We're really going to try to figure out how much you bill and how much business you generate. We're going to give you a large chunk of that. Other law firms are more lockstep. If you're a first-year partner, this is going to be your income. And I think probably in most cases, it's some blend of that model. And your compensation will ultimately be decided by a compensation committee that's going to decide how much you earn that year. In theory, we could wait until the end of the year to pay you, but you've got things like mortgages and tuition to pay. And so you can't wait till the end of the year. And so what we're going to do is we're going to give you a draw each month. It's going to be, we're going to estimate what we think you're going to earn for the year. We'll probably be conservative. And so we'll factor it by, let's say, 90%. And then we're going to divide it by 12, and that'll be your monthly draw. And then at the end of the year, if you ultimately earn, if your allocation committee decides that you have earned enough to cover your draws, then you don't have to pay it back. And because we only use 90% as our base, hopefully you get sort of extra, right, to make up the difference, to true it up. We did 90% because we didn't want to overdraw you, and then we have to go and get the money back from you, and that's annoying. So we kind of err on the side of giving you too little, and then it's a nice bonus at the end if you meet your expectations. So that's the way it works. And in fact, just as a matter of reality, usually the compensation committee is going to meet the next year. We can do this up until we have to file our partnership tax return. We're going to decide, we might meet in January of 2022 to decide your share of 2021 income. And that's perfectly permissible. We saw at 761C that says the partnership agreement can be amended up to the date of the filing of the tax return. So basically, tweaking the allocations can be done all the way till the partnership tax return is filed. And again, that gives the compensation committee the ability to look at the entire year and see what you've done and see how much you should get paid. Okay, and so in the draw, if you end up not earning enough, then you then owe the difference. You have to pay it back. And that's why the draw is really a loan and not a distribution. And why do they do it this way? Is because a draw is taken into account. A draw is not treated as a distribution until the end of the year. And that's good for you, because remember, you had a zero basis, outside basis in the partnership of this. So you didn't pay anything for it. You didn't buy it. You didn't contribute anything. It's a year, month one, January 1, let's say you get a distribution of $30,000, a draw. Well, without any special rule, that $30,000 distribution, distribution in excess of your outside basis, you'd have $30,000 in gain. And what'll end up happening is that'll happen every month, and then you'll get taxed. Let's say then you earn 360,000 as your distributive share, as your allocation. You'll get taxed on that 360 as well. So you'd end up with 720,000 of income / gain. You've only earned 360. You'll end up with a big loss at the end, but that's a pretty ugly situation. And so it just gets classified as a draw, where you have an agreement to pay it back if you don't earn it. And then what happens is the distribution of 30,000 a month times 12 is deemed to be made on December 31. What happens on December 31? On December 31, you get allocated your share of income from that year, which is 360. And so you get allocated your 360 of ordinary income from the law firm. That increases your outside basis from 0 to 360. Then you're distributed the cash, takes your outside basis from 360 down to 0 without a second level of gain. So a draw distribution is really not a distribution, it's treated as a loan. The distribution is going to be the cancellation of that loan at the end of the year. And it allows, in the service partnership context, your outside basis to first be adjusted by your income allocation for the year, which then avoids this sort of ugly double taxation. Questions on draws?
Yeah, where's the rule in the code for that?
Yeah, okay, it's in the regs. So let's turn to 1.731, 1.731-1, reg 1.731-1. -1, A1. So we're -1, A1, 2 little i's. So here's our rule. There's our draw. Purpose of section 731, which are gain in distribution of cash in excess of basis. 705, which is adjustments to outside basis. Advances or drawings of money or property against a partner's distributive share of income shall be treated as current distributions made on the last day of the partnership taxable year with respect to such partner. So you basically move them back to December 31, even though they're occurring on January 31, February 28, March 31, and so on and so forth. For tax purposes, they're all treated as occurring on December 31. Okay, any other questions about draws? So again, an exam situation, if it just says distribution, cash is distributed, there's no strings attached, we test it on that day. If it's a draw, then we test it on December 31, after the allocations of income have increased the outside basis. Okay, back to the code. Let's turn to section 732. So the question now is going to be, what if we receive property as a distribution? If we receive property as a distribution, we know there's no gain, because we only have gain if we receive money in excess of outside basis. If we receive property, then we have a question of, well, what is the basis of the property we get? We have to know what our basis in this property is. We have this general rule, which in 732A1, which says the basis of the property that we receive, other than money is, we don't have to ask the question of what's the basis of money. Money has a face basis distributed by a partnership to a partnership. Other than liquidation, shall, except as provided in paragraph 2, be its adjusted basis to the partnership. So it's a carryover basis. Whatever basis the property had in the partnership's hands, that becomes the basis of the partners. That becomes the partner's basis in the property. Carryover basis. And if we turn to 733, we'll get to the exception in a second. We turn to 733, we have this rule that says, okay, what's our basis in the partnership? What's our outside basis? Because we're still a partner. If we weren't a partner, it would be a liquidating distribution. We deal with different rules. But because we're still a partner, we now have a partnership, and we still have a partnership interest, we still have an outside basis. What is it? Well, when we get a distribution of property, we reduce the outside basis, not below zero, but then have money distributed, and the amount of the basis to such partner of distributed property. So it's kind of like an amoeba type basis. So you have a basis in this partnership interest. Some of that basis is going to then be shifted over to the basis of the property. So you're just splitting the basis between the property you're receiving and the outside basis that remains. Now the problem with that is, what if your outside basis is insufficient? So what if the basis of the property, the inside basis of the property being distributed, is higher than your outside basis? Well, with this rule, you'd end up with a negative outside basis, and we know that can't be the case. So that's what 732A2 is designed to do. And it says, look, we can't give you basis in the distributed property in excess of the adjusted basis in the partnership interest. That the basis we can give you in the property is maxed out, capped by your outside basis, less any cash distributed in the same transaction. Because the money is going to get that basis first. We got to give money face basis, no ifs, ands, or buts. Whatever outside basis is left, that's the cap. We can't give you more basis in that property than that, because then we're going to reduce your outside basis to zero. And if we gave you higher basis, we'd end up having to give you a negative outside basis. Okay, so those are the rules, the tax rules. Any questions about basis? We're going to do some problems, as you know, that'll help to clarify these sort of abstract concepts. What about book consequences? What about capital accounts and such? Let's turn to the capital account maintenance rules. So this is Reg 1.704-1B2, 4 little i's B, dash 10.704-1B2, 4 little i's B. This is our basic rules. And we know, we go to B5, that your capital account is reduced by the fair market value of property distributed to you. And again, that makes sense because capital accounts are designed to be economic, right? So your basis doesn't really matter. It's the fair market value of the property distributed. So we're reducing it by that. Now, because the property is booked at a different value than the fair market value, right? We have, it's generally going to be historical cost, less any formulaic depreciation, that it's not going to be booked at the fair market value before it's distributed, absent something else. And so we have to deal with that. And so dash 1B2 4 little i's E. So we're in V, we go C, D, E. Has a common sense rule that says, because we have to reduce your capital account by the fair market value of property being distributed, the capital accounts first must be adjusted to reflect the built-in gain or loss of the property and how that gain or loss would be allocated to the partners. We're going to book up or down the distributed property. Just that property when we have a distribution of property. We're not going to do a global book up or book down, a revaluation, but just that property. And that's going to make our books balance, because if we didn't do that, things would get out of whack. Because, I mean, just illustrate this. Let's say we've got property here with a book value of 10. We've got partner over here. And let's say this property is now worth 100. We're going to distribute it to partner A. Well, we know we're going to reduce partner A's capital accounts by 100 because that's our distribution. We're also going to have to book this up by 90. So we're going to also have a book up that's going to get allocated to the partners depending on how the partners agreed to share. That's going to be the book up. So we book it up and then it comes off the books here. So the net effect is going to be reducing the left side of the balance sheet by 10. We're going to also reduce the right side of the balance sheet by 10. And if we didn't have a book up, if we blew through that, our books wouldn't balance. So we're reducing the right side of the balance sheet by 100, reducing the left side of the balance sheet by 10. So we have to book up or book down distributed property to fair market value to keep our balance sheet balanced. And that's what that rule does. We can't do a global book up. We can't do a full on revaluation. The revaluation rule is an F. We've seen this before. Revaluations are permitted on certain events. We've seen it listed in F5. We've talked about contribution of money or property to a partnership. That's not what's going on here. This is a distribution. We can't have distributions if it's a distribution as consideration for an interest in the partnership. So if we're reducing someone's interest in the partnership, then we can do a full-on book up. But if it's what's known as sort of a pro rata distribution, then we're not reducing anyone's interest, and it's not a permissible book up event. Grant of an interest is consideration for services, so that's contribution of services. Non-compensatory partnership option, we're not going to cover. Also stock or securities where we do mark to market, that's not going to apply either. And so we don't do a global book up, but we book up the property that's being distributed. Okay, any questions on that? All right, well, let's go to these problems. I think they're on, I have an older version of the book in front of me. So I'm not sure what page they're on, but they're the problems. Three problems at the end of this assignment. So problem 1 deals with this situation here where we've got A, B, and C. They each have different outside basis. And they're going to be distributed cash and property. And so the cash is going to be 10,000 cash to each and 10,000 of property to each. And the property has a basis of 5 in the partnership's hands. And so let's start with A. A has an outside basis of 20. So the first question is going to be, does A have any gain? A is receiving cash. So again, you have a cash distribution. The first thing you would think about is there a gain? Because there could be gain. The answer here is no, there is no gain because A has a outside basis of 20 and cash distribution is only 10. So under 731A1, no gain is recognized. The next question would be, well, what is A's basis in the land? The land has a fair market value of 10. The basis to the partnership was 5 in that land. Under 731A1, A would take a carryover basis of 5 in the land. No gain under 731A1. And under 732A1, we'll take a $5,000 basis in the land. The 732A2 limitation does not apply because A's outside basis is 20, reduce it by the cash distributed, that's 10. We can't give A an outside basis in the land greater than 10, but we're only giving him 5. So the cap isn't a factor. And then what is A's outside basis going forward? New outside basis under 733 is the old basis minus 10 of cash distributed minus 5 of basis he takes in the land, which is going to be 5. That's 733. And if you think about it, it makes sense. A's outside basis starts at 20. 10 goes to the cash. 5 goes to the land. And 5 is left over. Any questions on A? Okay, we go to B. B's outside basis is 10. And again, no gain under 731A1 because the cash does not exceed the outside basis. Cash received by B and the distribution is 10, outside basis is 10. So no gain. Under 732A1, B would take a basis in the land of 5, again, carryover basis. But here is where the 732A2 limitation comes in and says we can't give him basis in the land greater than his outside basis less cash distributed in the same transaction, 0. So we take a 0 basis in the land. B is 732A2. And his outside basis under 733, his new outside basis is going to be his old outside basis, less cash distributed, less basis he takes in the land, 0. So B has no gain, no basis in the land, and no outside basis. Questions on B? Okay, C has an outside basis of 5. C has 5 of gain under 731A1. Receiving 10 of cash distribution, outside base is only 5. That excess is 5 of gain. Under 732, A2, again, his outside basis, 732A1, we give him 5 of base in the land. But A2 says we can't give him more base in the land, more than his outside basis less cash distributed, which is technically negative. So we can't give him more than 0. So it's 0 outside basis in the land. And then under 733, new outside basis is his old outside basis minus cash distributed minus the basis he takes in the land, which would be -5, but not less than 0. So 0. So C has 5 of gain on the distribution, no basis in the land, no outside basis. Any questions on, that's the answer is in A, for A, B, and C. And C obviously doesn't like this result. So and one way we can ameliorate this is if the cash distribution is a draw. So we'll see that in C. But in B, what if we now have 2 distributions? And let's assume there are 2 transactions, 2 separate transactions. We do the property first, and then the cash distribution next. So if we do the property distribution to C, C would take a 5,000 basis in the land. Because that's the land's basis in the partnership's hands. And 732A2 doesn't apply because we have enough outside basis at this point. And then C's outside basis is reduced to 0 under 733. 5,000 starting basis less the 5,000 basis he takes in the land. That's the property distribution. Then comes the cash distribution, and you'd have 10K of gain because he has no outside basis, receiving 10K of cash, 10,000 of gain. So before he had 5,000 of gain and no basis in the land. Now he has 10,000 of gain and 5 basis in the land. Again, this assumes these are separate, which is a question of fact. And you basically want them to be not part of a single distribution. You want them to be, the second distribution not intended at the time of the first would probably be the cleanest. But generally, this would not be advisable for C because C ends up with more gain during the year. And he has more basis in the land. Yeah, but basis in the land, that's cold basis. That's only going to be recovered if and when he sells the land. So generally, you wouldn't want this. You'd prefer the result where these are one transaction because it reduces his current gain, albeit it reduces his base in the land. Now, one way you might is if you have a bunch of capital losses here, or if you're in a low bracket this year, and I'm usually low bracket this year, I mean, you might want to accelerate gain, but typically you would not want, you typically would not prefer B over A for C. Okay. Questions on B? All right, and then in C, well, what if the distribution of cash is now a draw? So this distribution is not a draw. This is now a draw. Well, now what that allows you to do is that says, okay, this draw, even though it happens in October, we're going to treat it as happening on December 31. And also on December 31, he gets allocated 20,000 of income for the year. So on 7/31, his outside basis starts at 0. He gets allocated 20,000 of income. That increases his outside basis under section 705. Let's take a quick look at 705 since we haven't in a while. $705 says the outside basis of a partner shall be increased by his share of his sum of distributive share of taxable income. You get allocated income, outside basis goes up by the amount. So his outside basis goes up by 20, and then it goes down by 10. But now there's an outside basis of 20. That's enough to absorb the distribution. So there's, and then the outside basis goes down by 10 under 733.1. So his outside basis at the end of the year is 10,000, and there's no gain under 731A1. So again, the draw, by classifying as a draw, which would require C to return it if he doesn't get allocated at least 10,000 of income for the year, is that it basically causes the distribution to occur at the end of the year after the allocation of income is made. And that gives him now enough outside basis to absorb it. Okay, questions on that? All right, in problem 2, so problem 2 is simply dealing with property distributions. And so in this problem here, it's just a basis question. So in these problems, a partner's receiving 2 pieces of property. Property 1, which has they each have a fair market value of 10. Property 1 is a 40,000 adjusted basis. Property 2, also fair market value of 10, has a 20 of basis. I said outside basis, should be just basis. And the problem in all these problems is even distributed to a partner, and it's just property distributions, no cash, so we don't have any gain. We know that. Under 732A1, the partner would take these carryover basis. But the dilemma, the problem, is that the partner's outside basis is only 40. So we would give him 60 of outside basis under 732A1, but 732A2 comes in and says, no, the basis can't be greater than 40, his outside basis. And if this were one piece of property, then we know what the answer is. We would reduce that basis of the property down from 60 to 40. The problem is we have 2 properties. We know we got to reduce their basis in the aggregate by 20, but how do we allocate the basis reduction? we got to cram down this basis of 60. We got to get to 60. We got to get it to 40. So how do we do that? And there are rules in the code. This is just statutory rules. It's a little bit complex language, but again, if you play around with it, you work it in your mind a few times, it's actually not that complicated. And this is all in 732. So let's turn to the statute. Well, let's do in problem A, we've got A1 is an inventory item and 2 is a capital asset. And that's going to matter, as we'll see, for the rules of how we cram down that basis. So let's turn to 732. So again, what 732A1 would say, give the properties a basis of 40 and 20 respectively. 2 comes in and says you can't give them more than 40. 732C then tells us how to allocate. So the basis of distributed properties to which subsection A2 is applicable, that's us, shall be allocated. So we're going to give basis first to any unrealized receivables and inventory items, hot assets, in an amount equal to the adjusted basis of such property to the partnership. So we're going to first we're going to fill up the basis of these hot assets. And so that gives us our answer to problem part A. Is we're going to give, because number 1 is the hot asset, we're going to fill it up. So the answer to A is he'll take a 40,000 basis in number 1, and there's nothing left for number 2. That's the answer to A. And by the way, this rule is preserving the right character, because the gain that you would recognize on liquidation, or the loss you would recognize on liquidation, is capital, as we'll see, that this preserves the built-in ordinary loss and the built-in capital loss. So they work, these rules work. It's harder to sort of conceptualize that than it is to just apply the rules as written. And all you need to do is apply the rules as written. In B, we're reversing these. So now this is the inventory and this is the capital asset. And so again, the rule is first fill up the hot asset. So we'll give that the full carryover basis. And then whatever is left goes to the other property. Sorry. 20 basis in 2, 20 basis in 1. Okay, so that, the first rule is pretty simple. We're going to sort of prioritize giving the basis first to the hot assets, and then residually whatever's left to the cold assets. Then we go to C, and in C, they're both the same. In C and D, they're both the same character. So we can do C and D together. They're both the same. So we're not preferring one over the other. So this rule doesn't really help us thus far. What we've covered thus far doesn't tell us what to do. So we got to go further. So first, analyze receivables. And if the basis to be allocated is less than the sum of the adjusted basis, then we have to decrease. So that would be if they're both inventory items, we'd have to figure out how to do the decrease. It kicks us down to C3. And if this were both capital assets, then we would go down to B. We would give the 40 of basis to the other properties because they're capital assets, but then we would give them each carryover basis, and then because we need to decrease it down to 40, kick us down to C3. So this both of these rules in C and D, part C and D, are going to require us to go to 3 to tell us how to get from 60 to 40, because both the threshold conclusion is you give them each a carryover basis. So here it says the method of allocating decrease is going to be first to properties with unrealized depreciation, built-in loss, in proportion to their respective amounts of unrealized depreciation. So we're going to look at their built-in loss. And we're going to say, okay, number one has a built-in loss of 30. $10 fair market value, 40 of basis. Number two has a built-in loss of 10. 20 minus 10 gives us a total built-in loss of 40. And now we got this 20 of decrease. It's a 20 of cram down for property number one. Number one has 30 out of 40, 30 built-in loss at a total built-in loss of 40. Multiply that times the 20 cram down. That gives us 15. Property two has 10 out of 40 times 20. That gives us 5. So the 20 of reduction is going to go 15 and 5. So number one's basis is going to be 40 minus 15 equals 25. Number two's basis is going to be 20 minus 5 equals 15. So that's how we apportion the 40 of basis. That has to sum the 40. If it doesn't sum the 40, because that's our cap, we've done something wrong. And that's just the application. So the answer is 25 of basis to 1, 15 of basis to 2. And that's simply an application of this rule right here. And that's the case in both C or D. If they're both inventory items or both capital assets, that's going to be the answer. Okay. And there's no theory there, because unlike before, we're filling up the hot assets first and then the cold assets on a residual basis. That's conceptually correct. Once they're in the same class, then it's just we have to have a rule to sort of do it, and the Congress just picked in accordance with the built-in losses, pro rata in accordance with the built-in losses. Last problem is E. We just changed these facts here, and now we're going to have, we've got again the two properties, but now one has a fair market value of 60 and a basis of 40. Property number two has fair market value of 50 and a basis of 20. And again, we still have an outside basis of 40 before, and so we're going to cram this down from 60 down to 40, and they're the same class. They're both inventory items. So again, we go to our code, go to 732. Again, technically we start here. We're going to first give them to the inventory equal to their adjusted basis, which would be 60, sort of 40 and 20. but then we only can give them 40, so it kicks us down to 3. We go to C3. First property is unrealized depreciation. Well, the problem here is we don't have any properties with unrealized depreciation. These properties have unrealized appreciation. They have built-in gains. So we don't have to do anything under 3A. We go to 3B. So we're now in this rule. To the extent such decrease, again, the decrease is 20. We got to get from 60 to 40. To the extent that 20 is not allocated to paragraph A in proportion to their respective adjusted bases. So number 1 has 40 of basis over 60 of total basis. So that's 2/3. So we multiply that times 20. So that is 13.3. Number 2 has 20 of adjusted basis over 60 total adjusted basis times the 20 cram down. That's 6.7. So that's our reduction. So property number 1 goes from 40 minus 13.3 to 26.7. Property 2 goes from 20 minus 6.7 to 13.3. So that's our answer under these facts. Property 1, the partner takes property 1 with an adjusted base of 26.7. The partner takes property 2 with an adjusted basis of 13.3. Any questions on that? So again, I view this as like just, you got to get comfortable. This is just a procedure for a set of rules for allocating basis. And it's not a very long set of rules. By the way, for this purpose, we're never going to be allocating an increase here under 732A2. If we have the 732A2 limit coming into play, then to the extent, this rule here will not apply. We're never going to increase. It's always going to be governed by C1 or C3 or combination. The same kind of what we're going to see with liquidating distribute. That's where the B rule comes into play, and that's where both sets of rules can apply. So for this purpose, it's just, can you read 732C1 and C3? And again, just create your own fact patterns. You just need fair market values and basis of the properties, and you need an outside basis, and you can create your own hypotheticals pretty easily. Okay, well, we've run out of time. So for next class, we'll finish up this assignment. We got problem 3, and then we move on to consider the consequences to the other partners. And that's going to look similar in some respects to what we've done with 743B. We have its close cousin, 734B, that we'll cover on Wednesday. Okay, I'll see everybody on Wednesday. And as always, feel free to reach out via email if you want to talk about anything.